Breaking news from the Federal Reserve: interest rates have been cut yet again, but this time with a cautious warning. What does this mean for your loans, mortgages, and the economy? Let's break it all down for you. Welcome to Insightful Times. I'm your host Steve, and today we're diving into the Federal Reserve's latest decision that has everyone watching closely. The Fed announced a quarter-point rate cut, marking its third consecutive reduction. But the big story here: fewer rate cuts are expected in the coming years as inflation and economic growth hold strong. 1. The decision and what it means. On Wednesday, the Federal Open Market Committee lowered its key interest rate to a target range of 4.25% to 4.5%. This brings rates back to where they stood in December 2022. But here's the interesting part. While this move was widely anticipated, the Fed signaled it will likely only cut rates twice more in 2025, down from earlier expectations of 4 cuts. Cut to a brief graphic. Current rates future projections assuming cuts in quarter-point increments. The Fed projects additional reductions in 2026 and 2027. However, over the longer term, the Fed sees the neutral funds rate settling at 3%, slightly higher than previous estimates. Now, here's where things get tricky. Normally, the Fed cuts rates to fight a weak economy or tame falling inflation. But that's not the case this time. Inflation remains above the 2% target, and the economy is showing signs of resilience. The Fed even raised its full-year GDP growth projection to 2.5%, up half a percentage point from September. Cut to graphic. Key economic figures: GDP growth, inflation, unemployment. GDP growth expected to slow to 1.8% over the long term. Unemployment projected to hit 4.2%. Inflation, the Fed's preferred gauge, forecasts to 0.4% for headline inflation and to 0.8% for core inflation. These numbers show solid growth and steady employment conditions that don't typically align with interest rate cuts. So, why cut rates at all? Fed Chair Jerome Powell explained that the central bank wants to recalibrate policy to avoid keeping rates too high for too long, which could unnecessarily slow down the economy. But markets are pushing back. Despite the cuts, Treasury yields and mortgage rates have remained high. The 2-year Treasury yield recently hit 4.15%, signaling that investors may not believe the Fed has much room for further cuts. To recap, the Fed has lowered interest rates to 4.25% to 4.5%, but has signaled caution ahead, with fewer cuts expected in the coming years, with inflation still above target and economic growth holding strong. This is a balancing act that will shape the economy for months to come. As always, we'll keep you updated on what this means for you, whether it's your mortgages, loans, or savings. Stay tuned to Insightful Times for the latest updates. I'm Steve, and thank you for joining us. Don't forget to like, share, and subscribe for more insightful news. See you next time.